I'm Mark Beeston, as introduced, managing partner and founder of Illuminate Financial Management. We are a purely financial markets technology-focused venture capital fund, just completing the deployment of our first fund and raising our second. And I'm absolutely delighted to have somebody that has really demonstrated to us all how to grow an asset manager with me today, Barbara Novick. Barbara is the Vice Chairman of Blackrock, a member of Blackrock's Global Executive Committee, Corporate Risk Committee, and Global Operating Committee, founder of the firm, authored numerous articles on asset management and public policy issues, as well as being a member of the CFA's Institute for Future Financial Advisory Council. Barbara, thank you very much for joining me up here. We're all here to hear about the use of technology in the asset management industry. You're the biggest asset manager in the world. How do you think about fintech in the asset management space?
So first of all, nice to be here, and thank you all for coming and listening. I think you have to go back and think about technology, not just in the today, but if you understand Blackrock, our concept back 30 years ago was that technology was going to be important. So we're sitting here at FinTech today and looking at new uses of technology, but it's not like it's not already a technology business. When we think about technology, we think about three different buckets. One is the investment process itself. How can we use big data or other techniques to hopefully produce better returns for our investors? And many different places to look today, whether it is reading thousands of annual reports with machines, or it's taking tweets off the internet, just being able to see trends and understand what's happening as a leading indicator. Second area is the customer experience. So think about things like digital advisors, any sort of interface with a client. How can you give clients a better experience, better information, more timely, more user-friendly, things like that? And third is what we call operational efficiency. So at the end of the day, asset management includes moving tremendous amounts of data around. There's benchmarks, there's pricing data, there's rating agencies, there's the portfolio itself, many, many moving pieces. We have over $6 trillion under management. That is across thousands of portfolios. Each portfolio looks a little different. Many of them have different custodians, different clients. So the information management process is rather complex. We also have lots of regulators around the world, and we have to report to all of them. So think of it as RegTech. And how can you use the technology to take information out of your database, deliver it to different people in ways that are helpful to them?
It's kind of interesting to hear you say that because, as you know, in our model, we engage a lot with the industry. And in 2017, whenever I engaged with a buy-side firm that I'd never met before, I'd immediately open the conversation about MiFID II. It's the soft underbelly of things that people care about. I could guarantee you that within 15 minutes, virtually every single one of those conversations came back to data. What I think is really interesting actually is my sell-side conversations at the start of this year. I think they're finally lifting themselves above the regulatory challenge and starting to think about competitive advantage, and all those conversations have started talking about data. Now, I can't help but note that when you talk about that, you talked about three problem sets first and then technologies afterwards. But if I think about the hype cycle that we've been on, 2016 was the year of the blockchain. 2017 was the year of AI. I tell my investors that we're not really a technology investor. We're a business solutions investor that looks at technology second. How do you think about those types of technologies? Are you looking for technology or are you looking for solutions?
So I think you want to understand the technologies that are available. So again, going back and doing the historical and then taking it forward. When the internet first came and sort of hit the scene as a thing, many new companies started up, right? There was the dot-com craze. Many people came to us with business proposals, and they were fascinating because they had no idea how they were going to make money, but they were going to use the internet, and that was the magic. So clearly they had a first mover advantage, they had all the lingo, but when you asked them, but who's going to buy it and how are you going to make money, that was kind of like a blank stare. At that same moment in time, companies like ours said, let's embrace this technology and let's embed it in many of the things that we do at Blackrock. So we were an existing company as opposed to a startup, taking that technology, embracing it, and finding use cases for it. And it was extremely helpful in terms of operational efficiency, in terms of being able to have data information available worldwide. There was nothing that beat that. So you roll it forward and blockchain. I went to an event in Davos a few years ago. Blockchain was first hitting the scene. And it was a fascinating lunch and a number of very high-level academics, and they were really smart, and they were telling us all the things blockchain could do, and it was tremendous hype. I came back and I said, well, I guess blockchain is going to do our laundry too. I mean, it was going to do everything. But the reality was there was no clear use case. It was just there's this magical technology. So you look today, and many financial services firms, not just asset managers, have started experimenting with the technology, looking for use cases, trying to figure out how to harness this new thing. We have some ideas. Some of them involve settlement around bank loans, settlement issues throughout the industry that would make the industry more efficient and would actually make things less error-prone, speed up the settlement process. In addition, in the investment stewardship area, the voting in companies, there may be uses for blockchain to have a straight-through process for voting and that vote appearing at the company with a great audit trail to it. So there are use cases. I think it's developing, but I don't think blockchain is this great panacea. I want to also separate the technology from the hype around Bitcoin. Many regulators, and I'm on sort of a tour out here in Asia, many regulators are quite concerned about Bitcoin, and their concerns are investor protection concerns. What do you really own? Is it prone to theft and cyber risk? How do you get your hands on it if you want to redeem? There's many issues, and the regulators are really struggling with all sorts of currencies based on the technology. So I think you want to separate the ICOs from the use cases. I think there are a lot of legitimate use cases. I'm not sure that Bitcoin is the one that's going to long-term be the use case.
It's interesting to hear you say that blockchain is not the panacea. I think about the opportunity space for that technology as effectively being a cube that has three different dimensions. You've got the life cycle of a transaction, you've got all of the different asset classes as a second dimension, and then you've got all the different geographies that you could be applying that in as a third dimension. We haven't actually made a blockchain investment from our first fund, not because we don't believe in blockchain, but because it felt like everything was being priced as if it was solving the problem of the entire macro cube, whereas in fact most use cases are looking at a thin vector, or if they're lucky, a very thin slice. I think AI is very different because there are unilateral use cases straight out of the box. Again, we have made AI investments. They're driven by us caring about things like AML and exception management or trade surveillance or what have you, and it just happens that the technology that sits behind it are those kinds of technologies. I guess we move on to the build versus buy conundrum. I was at a tech conference in Palo Alto about a month ago. I heard a CTO of one of the major banks say that they now have a policy that they only build where they can't buy, and they only build until they can buy. I'm not sure I fully believe that that's entirely true, which is why I don't mention the name of the bank. You've obviously made a huge investment in Aladdin. You're not just an asset manager; you're a vendor and a big one at that. how do you think about the build versus buy and the role of fintech within that and within Aladdin itself?
So when we started Blackrock, we went through the build versus buy process. And what we found was there really was nothing to buy that satisfied our specifications. And that was actually surprising. I mean, as a new company, we assumed we would buy first and build later. But it put us in a position that we had to build because we knew what we wanted and it just didn't exist. So as we built it, it turned out we built something really special. And about 10 years into it, we realized we had something that other people wanted. And for us to continue to invest and stay state of the art, we determined that it would be a good idea to become a vendor. So the launch of Blackrock Solutions and the Aladdin product was very much tied to needing more scale and needing the revenue to be able to keep the system as far forward as it has stayed. We do sometimes buy technology. We've bought companies. We've bought Future Advisor, which is a digital advisor. We bought something, we made an investment, a minority investment in something similar in Europe called Scalable Capital. We recently bought something called Cash Matrix in the cash management space. So sometimes we buy, sometimes we partner, sometimes we take a minority interest. But we do look at technologies that are not invented here. And we think that that's important to stay current and to be able to integrate the best ideas.
Fantastic. So obviously we touched on you touched on RegTech earlier, and we've been talking about fintech in terms of process efficiency or investment efficiency. Of course, there's another side to it, which is the whole security and risk side, cyber, financial stability, anti-money laundering. Are you active in those spaces? How do you think about them? I'm sure that Blackrock is, on the cyber side, a very large target. There must be an awful lot going on behind the scenes.
Well, I think it's obvious that everybody is a target, large or small, and you have to have a really robust program for cyber. We're fortunate in that we don't have a lot of personal information. Most of our business is an institutional business. Where we deal with retail, it's through intermediaries. So our cyber problems are a little bit different. But absolutely, I mean, you have to have a robust capability. It's just part of every business, financial services or not. I mean, some of the issues that have come up in the last year, health, hospitals, health insurance, all sorts of areas. So it's just ingrained in what you do.
Yeah, interesting. I always like to kind of joke that we're a fintech investor where one of our portfolio companies actually has the National Health Service as one of their clients, which is a privacy solution, which is again as applicable to any of these insightful data sets as it is to the financial markets data set. Question I get asked a lot is, what is the regulator's role in all of this? Not to lead the witness, but I'll tell you what I always say, and then you can say what you think. But for me, I say the regulator's role is to set the regulation, keep it stable, and let the entrepreneurs get on with it. But maybe I'm just fighting the corner of the little guy. What's your perspective on the role of the regulator in fintech and regtech?
So it's an interesting question because I think there's two sides. The, quote, little guy fears that the big ones are creating a moat and they can't compete. And the big guys are looking around and saying, hey, it's not fair if you don't apply the same set of rules to the little guy. So it depends which side of that moat you're standing on, the little guy side or the big guy side. But I think for regulators, really, their role is to set the rules, make them fair, make them more activities-based, and I think many of the regulators we're talking to are starting to think more that way. If you're looking at a payment system, does it matter if it's a fintech solution or if it's an existing bank? If you're looking at a digital advisor, does it matter that it's a digital advisor versus a human being as an advisor? Know your customer rules, fairness, transparency, like a lot of the same rules that come up if it's a human being. The computer's not magical. Somebody programmed the computer. There's an algorithm there. There's something that should be comparable not necessarily identical, but comparable. And I think you don't want the Wild West, but you also don't want a moat that's so high you don't allow any startups to compete.
Just to pick up on something you said there, because you also mentioned your investment in Scalable. Again, we hear a lot in the space about active versus passive. I think one observation is is it actually moving to a hybrid model, or is it at one end of the scale or another? Of course, a lot of those more sort of passive or robo type environments have also not been tested in a downturn. So it's been an interesting market the last couple of months, and I wonder if at that point people start wishing they could talk to a human. Do you have any perspective on that?
So digital advice is fascinating, and I think in some sense, it democratizes advice for people even with small balances. When you look at the actual numbers of who's using digital advice, in many cases, it's very wealthy investors. So I think the urban legend of it's just going to be the little guy doesn't stack up when you look at the actual numbers. I also think when you look at digital advice, it's not all passive. And we don't even like to use the word passive. We call it index versus active, because many index strategies might be based on an algorithm or an index that is not just market capitalization. So you have today, we call it a continuum, going from a pure index out to smart beta and then out to more active and increasingly concentrated strategies. And some of the robo-advisors will allow a very broad product set, including active management. Some of them are very limited to only the most basic indexing, and some of them have things across that continuum. So I think it behooves anybody as a client who's looking at using a robo-advisor or a digital advisor to understand what's behind it. What's the algorithm? Are there any biases in it? What's the product set that they will incorporate? Because they really are different from one to another. In terms of human beings, it's also fascinating. One of the large companies, and I'll stay anonymous on companies, one of the large companies in this space announced a few months back that they were hiring people to answer the phone. Because it turns out that a lot of those clients who thought they wanted self-help, when they have a question, they want a person. So even the pure digital advisors are finding you really need somewhat of a hybrid where it's the combination of technology and humans that really is the magic.
I don't think people will ever catch on, but you heard it here first. So changing tack, a slightly dirty word, procurement. Our business very much focuses on the institutional side of financial markets technology, and it's just a known challenge that you can be talking about 18-month or 2-year sales cycles. A number of the institutions that we work with have instituted policies and procedures that are designed to recognize that a fintech is a little different from a Bloomberg or a Refinitiv or one of the major vendors. I wonder if Blackrock is doing anything new in that space in terms of differentiating, because at the end of the day you obviously have the same risk challenges but very different vendor sets.
So we have a whole vendor management program, and one of the things we do is upfront due diligence, obviously, to understand the robustness of the company as well as the product. We then continue that on an ongoing basis. So I think one of the fallacies is you can do due diligence once on something you're going to buy, and then it's all great. You actually have to refresh that, just like it's a credit exposure or any other exposure you have as a company or in the portfolios. So we have a number of processes in place to go back and revisit the diligence we've done. We also have business continuity plans in place so that if a vendor were to fail, if a vendor had a problem, we have a backup plan. And I think anytime you're outsourcing, that has to be part of your thought process. What if this company can't perform? What else can I do? How much robustness do I have in the backup?
So I mean, you've been on an amazing journey, right? From a founder of the firm right the way through to the largest asset manager in the world. There's be a lot of fintechs in the room that want to be achieving the same on their own fintech journey. if you were founding a fintech today that wanted to, sell or build a relationship or partner with BlackRock, what would you be doing? Or if you were advising one of those firms, what would you be telling them?
So I think the starting point is you have to have an idea that actually solves somebody's problem. And I know that sounds so obvious, but when I talk about the dot-com companies that were coming with all these crazy proposals, frankly, none of them were interesting to us to use as a vendor, never mind to invest in their company. So I think the first thing is, what problem is it you're going to solve? When we started our business, why were we successful? We went out on listening tours, and we asked people in the pension industry, what problems did they have? And then we came back and we created some asset management products that solved those problems. And even today, our business is very much a solutions-based business. So if you want to start any kind of company, I don't think it's fintech specific, think about how are you going to help somebody else solve their problem, make it less time consuming, make it less expensive, do something that improves their business, and then you've got a real product. And then you've got the ear of the other person. If it's, you think you've invented the greatest thing, blockchain, and you're trying to convince someone to use it, but they don't see any use case, it's just not going to go anywhere.
Right. I think listening is definitely a key. I'm going to take it to some of the questions that the audience have. So if you have more questions, please feel free to put them up. There's one here that I really like, which is if the hype of 2017 is blockchain and 2018 is AI, what do you think will be the hype in 2019? Presumably so we can all run out and buy those private stocks. So what do you think? What do you think to that, Barbara? Where are we headed?
Well, I guess the third one in that group that's missing is machine learning.
Yeah.
They sort of come as a threesome. It's like triplets.
Yeah, I think it's actually pretty interesting. We were meeting with one of our investors, and he asked one of my business partners what he thought the big technology of 2019 was going to be, and he actually said cloud and big data. And it sounds pretty asinine, but in reality, in the large a lot of the large institutions, we're a long way behind where we are as personal individuals in our use of these kinds of technology. So, you don't have to look too far into the future to see where we're going. It's a lot of stuff that we've already adopted personally. Unfortunately, I can't see the other questions because that question is now showing on the screen. So.
There was a question about retail adoption of digital advice.
Oh, there you go.
There it is.
What do you think is constraining the wider adoption, retail adoption of digital advice?
Next.
There you go. Did you submit that one?
No, but I read it faster than the first one.
Okay.
These are in this font that's like this big, but then they make it bigger. Retail usage. I look at a generational change. People in my generation are adopting some of the digital tools, and certainly we all have iPhones and we all have many applications and use a lot of the same things that the younger people use. I happen to love Uber as just an example of something that's so simple and so obvious as a solution that a problem people had all over the world. When you look at digital advice, I think people, let's say under the age of 30, will gravitate to it because it's just part of what they grew up with as technology, and it's just one more example, right? They do online banking. They take a picture of a check, and that's how they deposit it. They never walk into a bank branch. So why not have their investments also online? And I think we're going to see, whether it's 10 years from now or even sooner, a growing number of retail investors gravitate to digital.
Fantastic. We're over time here, so I'd like to thank Barbara, and I'd like you to show your appreciation. I think we've been honored to have such a pioneer within both the asset management industry, but also fintech in its own right. So thank you very much, Barbara.
Thank you, Mark.